Testing. 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 1, 2, 3. Testing. Testing. 1, 2, 3. Okay, we're going to get started here in just a moment. If anyone is joining me live, say hi in the comments. Would love to say hi back. I'm going to go ahead and get started here now. Hello, my Life with Crypto brothers and sisters. Welcome to another Money Monday crypto training. As always, I'm your host, Kelly Sunshall. Today we're finishing up our 4-part series on fundamental analysis, and our focus will be on financial metrics. Excuse me. Here's a quick reminder of all the other 4 parts in the series. We did macroeconomics in part 1. Part 2 was project metrics. Part 3 was blockchain metrics. And part 4 is financial metrics. Excuse me, I got a frog in my throat. Hey, Mike, nice to have you here as always. Now, you can find the replays in the guide section of my Facebook group for all those other parts I just mentioned, or you can go to my YouTube channel and you can see them there. And if you can't find either of those, just send me an email and I'll send you a direct link. So let's go ahead and get started. I do have a lot of material to cover today. It's hard for me not to do a deep dive because that is my nature. So we're going to jump into it. And I will let you know that I did have to get up at 5 o'clock this morning one more time for my for the last week of this crypto training that I'm doing. So I am a little bit tired, but I have a very full training for you today. So I hope you enjoy. Let me know what you think. So, financial metrics, the 4th and final group of fundamental analysis metrics. For our introductory training, I'll keep it pretty high level and cover just the basics. For more in-depth training on tokenomics, excuse me, you can consider joining my Let's Crypto membership program. Aspects of financial metrics can also fall under the category of tokenomics, so I will keep it simple today because we could easily spend hours on this subject. And I do enjoy researching financial metrics because they are quantitative, meaning they're about numbers, which makes looking for and finding data, I think, easier than trying to, search for things on social media, which I find much more difficult. But trying to find numbers is usually a lot easier. So here are 4 financial metrics that I like to look for when I'm looking at financial metrics. The first one is market capitalization, also known as market cap. We have total value locked, we have volume, and supply. And we're going to look at all 4 of those in depth today. Now, a couple of things to keep in mind. All of the metrics listed above are interconnected, and this will make more sense as we go along and we look at a few equations. So these metrics are not very useful by themselves, not really. They are much more helpful when compared between tokens or when you use them in conjunction with other information. So they're not very useful standalone, but when you look at these metrics across several different tokens, you start to paint a picture, is what I'm trying to say. So the first one is market capitalization or market cap. And market cap is a metric used to measure the total dollar value of a cryptocurrency. It is a widely used quantitative metric for evaluating crypto assets' size, risk, and liquidity. It's important to note that market cap is a snapshot in time and can fluctuate rapidly due to price action and circulating supply. It is calculated by multiplying the current price of a crypto asset by its circulating supply. And here's the formula. Market cap equals current price per token times circulating supply. So what is the importance of market cap? Well, we've got several here. First one is relative size. It allows investors to gauge a crypto's assets' relative size and significance within the broader market. A higher market cap generally indicates greater adoption and popularity. Market cap, we can look at risk management. Market cap can provide insights into a cryptocurrency's risk profile. Larger market caps are often associated with lower risk and volatility, while smaller market caps tend to be a bit riskier, but they could offer higher returns. So you have to decide what your risk-reward ratio is or what your risk profile is to determine whether high volatility is more important to you or low volatility. If you're after high risk assets, you might look at stuff with lower volatility. So it's all relative. It could be a liquidity indicator. Cryptocurrencies with higher market caps tend to have greater liquidity and trading volume, making them easier to buy and sell on exchanges. And that's one of the main things I think people look for in market cap. I think we have one, nope, not one more. All right, let's look at some categories of market cap. Now, I did do some research on this, and not everybody agrees on these numbers, but I saw these numbers more often than I saw other numbers, so I stuck with these. Cryptocurrencies can be categorized by their market cap, and we have several. I stuck with the top three, which is large cap, mid cap, and small cap. So in general, large cap is a market cap of over $10 billion, which is considered a safer investment with low volatility, and I assume that would be something like Bitcoin and probably Ether. Mid cap would be a market cap between 1 billion and 10 billion. It is more volatile but with higher growth potential. And a small cap is a market cap below $1 million. It is highly volatile and riskier but may offer significant growth opportunities. Now, I also saw micro cap and nano cap because, of course, we look at projects that might have in the millions of dollars worth of cap, not just billions of dollars. So you could add a couple of more to this list if you wanted to, but I just stuck with the top three. So let's go on now and look at financial metric number 2, total value locked. TVL represents the sum of all crypto assets deposited by users or locked into DeFi smart contracts. The TVL is a dynamic metric that changes in real time, and it can be tracked for a single protocol or for an entire chain. It can also be used in trading to judge whether the market is correctly pricing a project's token. A high TVL with a low price could mean there's room for the price to appreciate. A rising TVL signals increasing liquidity, which might translate to higher yields for DeFi farmers. And one of the tools that I like to use for TVL, which many of you know, is DeFi Llama. And below, I'm going to show you 2 TVL charts, one for Ethereum and one for Avalanche. And I want you to tell me, which one do you like best? So here's the chart for TVL for Ethereum. All right, and now we're going to look at the one for Avalanche. So TVL and market cap can tell you a lot just looking at a chart. So here's Avalanche, and here's Ethereum. If anybody's listening that wants to comment, let me know in the comments which one you like better. All right, I'm going to move on. And which one you like better just from looking at the chart, nothing else. Doesn't mean that you're interested in buying it, doesn't mean anything. It's just basically just looking at those 2 charts. Which one has the better TVL? All right, there's a ratio for TVL that I want to share with you. It's called the formula for TVL ratio, and the TVL ratio is market cap divided by total value locked, which can assess whether a DeFi asset is undervalued or overvalued, which can provide insights for investment decisions. Of course, it's best to get something that's undervalued, that's high quality but undervalued, because then you can get it at a lower price and hope that it'll appreciate. So the TVL ratio is, like I said, here's the formula, equals market cap divided by total value locked. So all you have to do is go find those two numbers and divide it, and in a moment I'll tell you what it might tell you. So what is the importance of TVL? So TVL is an essential DeFi metric to determine a protocol's health. And here are some things to consider. Liquidity and adoption. A higher TVL generally indicates wide adoption by users. Trust and confidence. A high TVL implies trust by users who are willing to commit their money to it. So if people are putting their money into it, meaning we get a higher TVL, that implies some trust in that protocol. Risk management. A protocol with high TVL is often considered less risky because it's been battle tested by many prior users. And lastly is the TVL ratio. A TVL ratio less than 1 implies an asset is undervalued, and a ratio greater than 1 implies that an asset is overvalued. All right, I'm just giving you the high-level information about this stuff today. You can always take some of this and continue on doing some of your own research if you want to try putting it into practice. Okay, let's look at financial metric number 3, which is volume. Now, volume in crypto refers to the total amount of transactions traded over a specific period, which is usually 24 hours. It is an important metric that provides insight into trading activity and liquidity. It measures the amount of crypto being bought and sold on the market. Now there's another ratio I want to share with you here, and that's the volume ratio. And in this formula, we would take 24-hour trading volume divided by market cap. Now you can find the 24-hour trading volume and the market cap on websites like CoinMarketCap or CoinGecko. Those two numbers are there on both those sites. So what is the importance of volume or the volume ratio? Well, if a crypto has low volume, it tends to be a sign that interest in that asset is waning. So let's look at some things about volume. Market sentiment. High trading volumes indicate increased market activity. So for liquidity, high trading volume means more liquidity for buying and selling. You got to have high volume or high liquidity, because without it, you could get wrecked from slippage. Price movement. High trading volumes can drive prices up or down. So if we're in a, depending on which way the market is trending, when the volumes increase, it tends to continue the trend, or it can show that there's a reversal that's about to happen. I find volume very important when I'm looking at charts. And lastly, a high volume ratio means high liquidity. So that means the crypto can be easily bought or sold, and a low volume ratio means the asset is illiquid and may be difficult to buy or sell. So I find some of these formulas can be a bit helpful. I don't do them all the time, but sometimes I look at certain ones of these. But I want you to know that they exist so that you can all decide whether they're important to you or not. Because what's important to me might not be important to you, or it might be important to you. Everybody's different, and you got to follow your own style. So let's look at volume categories. There are two types of volume categories. One is total volume, which is the one that you could find on CoinGecko or CoinMarketCap. It's the total amount of crypto that was traded, usually over 24 hours, and it is represented as a single number. But relative volume is what you would see on a chart. It's the total amount of crypto traded during a specific period of time, and it depends on what you have your chart set at. So if you're looking at the hourly, daily, or weekly chart, you can turn volume indicator on, and you could see the volume, usually in a bar chart, the volume for that period of time. So for one particular hour or one particular day. And as I said, it's usually represented as a bar on the chart. Okay, moving along, we're already to our, I think this is our last one. Number 4 is our supply financial metric. So supply refers to the total number of tokens that exist for a particular crypto asset. And there are 3 main types of supply metrics that I like to look at. And I do find these important. Total supply represents the total number of tokens that have been minted and are in existence, and it includes both the tokens that are in circulation and those that are locked. Circulating supply indicates the number of coins or tokens actively traded and available for buying and selling, and it excludes tokens that are locked or reserved. And the maximum supply is the total number of tokens that will ever be created or minted for a particular crypto. So max supply could be predetermined, like Bitcoin. Bitcoin has 21 million tokens that will ever be minted, or it could be unlimited, like Ethereum. I don't think everybody knows that since they moved from proof of work to proof of stake, well, maybe it was before, I don't know for sure, but I do know that they now have an unlimited supply of tokens, which is kind of odd, really, for such a popular high market cap project, because usually, when you have such a huge supply of tokens, that inflates the price. But since they switched to proof of stake, they do have a burning schedule, and that burning schedule is what's allowing the price to not get overly inflated. I hope that made a little bit of sense. So I do have another formula here, and it's the circulating supply ratio. And this ratio is circulating supply divided by max supply. And don't be confused. Sometimes you'll see total supply and circulating supply is the same number. Sometimes circulating supply and max supply will be the same number. When you're trying to process this formula, start with circulating supply, because you'll always have that. And the other number for max supply, it will either be max supply or you'll use total supply. Because if max supply is infinity, which it is for Ethereum, this formula is not going to be very useful. So in that case, I would use circulating supply divided by total supply. All right, what is some importance reasons here for supply? So a lower circulating supply ratio, which means it's closer to zero, indicates that a smaller portion of that total supply is currently available for trading. And this can suggest greater scarcity and potential for price appreciation if demand increases. A higher circulating supply ratio, which means the number gets closer to 1, means that a larger portion of the total supply is already in circulation, potentially indicating a more mature market with higher liquidity. And that's actually the case if you go look at Bitcoin. If you calculate this formula for Bitcoin, which I did today, you'll see that the circulating supply ratio is very close to 1. It was something like 0.92 or 0.93, which makes sense because almost all of Bitcoin that's can be minted already has been. So that is all I have for you for today's training. I hope you all found some of that useful. I do know it's a little bit more technical information, and it's kind of hard to find a good way to present it. But you really need to look at these financial metrics and get comfortable looking at numbers and playing with a few of those formulas. Learning what to look for in financial metrics is a necessary part of crypto. And I hope that if you have any questions, feel free to email me or text me or DM me on Facebook. And I hope I see you all in the next training. So as always, stay curious, keep learning, and share your comments below, or feel free to DM me if you want to ask me direct. Now, I'm not planning on having a Money Monday training next week. I might take the next few weeks off because I want to focus on my own portfolio for a little while, but I'll let you know for sure by making a post on Facebook. So if there's no questions, I will say bye for now. Take care, everybody.